Okay. So these are some of the ways. Use of information communication technology, like computerized. Right now, they have a new, uh, they have a new customs management system for processing of imports to ensure probably there's no manual interference so that it's efficient. And then, yes, B says, outline 4 instances where the commissioner might suspend a license issued under the Excise Duty Act. So the licenses issued under the Excise Duty Act is like a license for processing liquor, distilleries, a license for cigarettes, companies like VAT, EABL have to be licensed directly by KRA, so that when you produce distilled spirits, you put a stamp. So they're asking 4 instances when the commissioner may suspend a license under the Excise Duty Act. So B, circumstances which commissioner may suspend license. Excise Duty Act. The first circumstance is where the company has failed to comply the provisions of the Excise Duty Act So if you fail to comply with the provisions of this act, then the license is suspended, where the company has been declared guilty of an offense. The company has been declared guilty of an offense. The company has submitted fraudulent information to the commission they have submitted fraudulent information to the commissioner, and finally, the factory and facilities are no longer adequate. For processing excisable goods. So the factory and facilities are no longer adequate for processing the excisable goods. All right. Then you look at C. C says Kalebu Wekesa and Babu are in partnership trading as Kaweba traders and sharing profits and losses equally. The partners have presented the following statement of profit and loss for the year ended 31st December 2021. So sales, opening stock, purchases, closing stock, gross profit, profit on sale of furniture, insurance compensation for stolen car, discount received, farming income, dividend income is net, less expenses, mortgage interest, furniture cost, depreciation, general expenses, salaries and wages, customs duty, conveyance fee, legal expenses, repairs and maintenance, VAT, interest on capital, bank charges, rent and rates, auditing and accountancy fees, motor vehicle expenses, insurance premiums, giving us net loss, additional information, mortgage interest related to a partner's residential house. Insurance premiums include $259,900 paid to insure Wekesa's private car. 3, the investment allowances were agreed with the Revenue Authority at $1,357,000 during the year ended. The partners took goods for personal use, which have been recorded as sales, which had a cost price of $207,000. The gross profit margin was 20%. Salaries and wages include Kalebu, Wekesa Babu, interest on capital comprised Kalebu, Wekesa Babu. Legal fees included preparation of tender documents, parking fines paid to county government, court charges for breach of contract, appeal against tax assessment, defending a partner in a local committee. General expenses included embezzlement by a cashier, registration of a trademark, office partitions, director's Christmas party, repairs and maintenance comprised new office tables, laptop and computers, and fixing of broken chairs and tables required, adjusted partnership. Sorry, it should be a statement of adjusted partnership profit or loss for the year, then allocation. So prepare a statement for adjusted partnership profit or loss. In this part should be sufficient. Acha tu tufute hapa tena. So this is part C. So the business is called Kaweba Trading. Now, the parties, this is the status in terms of, no, sorry, let me see. We are talking about the receipts. This relates to the object or target that is to be achieved. So we reported those. The object target for a customer is to be achieved. Abdi, please, can you mute? Is what we do. And the first thing we look at is the data. One of the is data. They've reported notes. $40.52.77, that's negative. Then you say add back. So we'll start our adjustments from the trading account. And looking at the notes, what we'll touch on the trading account is note 4. The partners took goods for personal use, which have been recorded as sales, even though the goods were not sold. Recorded as sales, which had a cost price of 207. The gross profit margin was 20%. So for these drawings, we need both the selling price and the cost price. So the cost price we have, so we'll add back the goods at cost price. Later we shall deduct the selling price. So let's work out the selling price of the goods. So work out the selling price of these goods. So note 4. So goods taken for personal use. So goods taken. So this is personal. Goods taken. The cost of those goods is 207. So cost price. It's 207. So what we need is to add markup. Then we arrive at the selling price. But what we've been given is the margin. So we must convert this. We did the other time, markup and margin. So what we have is margin. So margin, if markup as a fraction is 1 over n, margin is 1 over n plus 1. So margin here is 20%, which is 1 over 5. So markup is 1/5 minus 1, which is a quarter. So this is at 25%. So we get 25% of 207. So let's get 25%. So that's 51.75. So if you add this, you get 258.75. That's the selling price. So what do? We'll add back the cost price. So back to our statement, we say goods taken for personal use. You add back at cost. So the cost is 207. So later we shall deduct the selling price, which has been included in the sales because the goods were not sold. So any other adjustment in the trading account, there is. It was only note 4. We don't have any other item touching on the trading account. So we go to expenses. The first expense is called mortgage interest. Mortgage interest, there is additional information. Number 1, mortgage interest related to a partner's residential house. So it's personal mortgage interest. So this one relates to a partner. So add back 552. Mortgage interest. Next, we have furniture cost is 138. Depreciation is 529. General expenses, there is a note 8. We'll add back embezzlement by cashier. Embezzlement by cashier is 678. Then we have registration of trademark. $337.25. Registration of trademark office partitions. Office partition or just partition. Office partition is 510. So office partition is capital expenditure. Director's Christmas party. That is a private cost. So that was under general expenses. Trademark cannot be allowable as an expense. No, because a trademark is an asset. So where is the trademark? Registration of a trademark is capital expenditure. So you add it to the cost of a trademark. A trademark is an asset, even if it's intangible, you cannot deduct it. You can deduct for accounting purposes, but not for tax, because it's related to an asset. A trademark is an asset, even though it's intangible. I hope we have added it back. It's here. Registering a trademark should be added to the cost of the trademark. Next, you have salaries and wages. There is note 5. I will add back partner salaries. So partner salaries included a label. Yes, sir. I think 80 Babu. That is salaries to partners. Customs duties are tax is customs duty is 195.5. $195.5. Conveyance fees is legal costs relating to purchasing of property. Conveyance fees we add back. That's related to buying buildings or land. So that's capital expenditure. But then customs duty was wrong. It's 209.3. Customs duty is 209.3. So that next is conveyance. Conveyance fees is only 195.5. Legal expenses is in note 7. Preparation of tender documents is allowable. That's for buying of inventory. That's for purchase of inventory. That's allowable. We are note 7. Parking fines is a penalty, 138. So I'll add back parking fines. So parking fines is a penalty. Add back 138. Court charges for breach 368. Court charges for breach is 368. Appeal against tax assessment. Appeal against tax assessment. It's 75. Defending a partner in a local committee. So defense in any court or local committee on tax appeal is not allowable. Defending partner. Local committee. So that's a hearing, a tax appeal. So all tax appeal cases are not allowable, whether it's to the court or local committee, 216.2. That's legal expenses. Repairs and maintenance, there's a note 9. For repairs and maintenance, there's a note there. So note 9 says new office tables, so that's capital expense. So new office tables. It's 280. Laptops and computers. Sport party. Fixing broken chairs and tables is allowable. That's normal repairs. Then back to the statement, VAT paid is 94.3. Interest on capital I think it's the same figure we have in note 6. Interest on capital, yeah, is the same if you add. So there is interest on capital, on partners' capital. So the breakdown is in note 6. Kalebu interest on capital is 374.9. Wekesa is 170.2. Babu is 414. That's interest on capital. Bank charges is allowable expense. Rent and rates is allowable expense. Okay, rent and rates. Auditing and accountancy fees is allowable expense. Motor vehicle expenses allowable. Insurance premium, there's a note number 2. Insurance premiums includes 259.9 paid to insure Wekesa's private car. So we have insurance. Insurance for Wekesa's car. Insurance for Wekesa's car is 259.9. We've added that back. So these are the add backs. Any question on add backs? Anyone with a question? Then we'll get the deductions here below. So let's deduct. So first of all, we'll deduct from sales this selling price of goods that were taken for personal use by partners, 258.75. So goods taken for personal use. This time at the selling price. So the selling price, we had calculated 258.75. Then we go to the incomes in the income statement. Other incomes after gross profit. Profit on sale of furniture is 1359.3. Profit on sale of furniture. Is 1359.3. Insurance compensation is for a car. So that's capital. So insurance compensation is for a car. So these are car, a stolen car. 713 with that. Discounts received is business income. That's trading. That's part of trading profit. So you don't deduct discounts. Farming is other specified sources. So farming. So farming income. Other sources, we deduct 192.050. Dividend is other sources, 517.5. 517.5. Then investment allowances was agreed, so we don't need to calculate. Look at note 3. The investment allowances were agreed with the Revenue Authority at 1357 during the year. So I'll also deduct investment allowances as agreed. So investment allowances agreed is 1357. So we can get our adjusted profit or loss for the first part. So I'll add these deductions: 258.75 plus 1359.3 plus 713 plus 192.05 plus 517.5 plus 1357. So this one will give us 4397. 4397.6. Those are deductions. And then the add backs is 207. Add 552 plus 138 plus 529 plus 678 plus 337.5 plus 510 plus 575 plus 1035 plus 1380 plus 1150 plus 209.3 plus 185.5 plus 138 plus 368 plus 85 plus 216.2 plus 280 plus 430 plus 94.3 374 so plus 374.9 plus 170 so this total you can confirm is 9,512.5. So that we subtract the loss 4052.77, then minus the deductions also 4397.6. The result is 1062.13. The adjusted profit is 1062.13. Any question? So 1062.13 is our first part. Then, as usual, you will be required to distribute that. There must be distribution because you cannot tax the business because the business is not a legal entity. It does not exist in law. So you have to distribute that to the partners so that the partners can be taxed. So next we'll prepare a distribution schedule. So on 2, let's prepare a distribution schedule. So we want to distribute this to the partners. Karibu, they share profits and losses equally, so 1/3. We can now do our allocations. We can do the allocations. We can allocate salaries. Salaries are in note 5. So note 5 are salaries. $10.35, $13.80. And $11.50. Then you have interest on capital. So interest on capital, again, is in note 6. Kalebu is 374. And 9. The case is 170.2. And this is 414. Then we get the total. $959.1. They had no other payment to the partners, so the rest would be share of paid or plus. So this is they have just a profit we had already calculated. We're going to include that. Then we get the difference, see what is left. Huh? So 1062.13 minus 3565 minus 959.1. The difference is 34.61.97. 34.61.97, we divide that by 3, and we get 11.99. Then we simply add for each partner. So Kalebu is 1035, add 374.9 plus 1152.99. It is 2562.89. Then 1380 plus 170.2 plus 1153.99. We get 2704. Then we have 1150 plus 414 plus 11 53.99, again 27, 17.99. Then you add, let's see whether we get the, oh, hii ilikuwa negative, sorry. This was negative. I've added wrongly. Hii ilikuwa negative. So I have to add again. So these figures are not correct. I used positive instead of negative. Okay, so we have 1035 plus 374.9 minus 1153.99. So this should be 255. 255.91. Then we have 1380 plus 170.2 minus 1153.99, and we get 396. So 396.21. 396.21. Then you have 1150 plus 414 minus 1153.99. 410 and 0. 1 minute. The idea of battery. How to run a good Okay. Sorry for that. So far, what we've shared there is just income from trading. Kwa hivyo nimejaribu kutuma text inakataa, but nimekutumia namba kwa WhatsApp. Uko na mahali unaweza andika? You have, iko kwa WhatsApp, but if you had a place to write, I would have just read it to you. Sawa, utaangalia kwa WhatsApp basi. Okay. Okay, so this is trading income right here. What we had adjusted earlier is what we've shared there. Now I'll look for any other income, the incomes after gross profit. So profit on sale of furniture is a capital gain that is not taxable. Insurance compensation for stolen car, that's a capital item. Again, that's not taxable. Discounts received, that was already there. It was part of trading, but we can share farming, only farming income, because for dividend, unless it's from a cooperative society, withholding tax of 5% is final tax, but we can share this farming income. So I'll come here and say farming income. The total farming income received is 192.050. So 192.050, I divide by 3, they share equally. So this will be 64. 64.017, 64.017, 64.017. Then I'll just get the total taxable income. There is no other income. So add this. So add for each one. So 255.91. This is 319. This other one is 396.21. This is as 460.227. And then 410.01. 0.01, yeah, 0.01 plus 64. Then gives us 474.027. So that's it. That question is done. And like we said earlier, then we also end partnership there. So that our next topic is limited liability companies. C's. So if you have a question, you can ask before we introduce the next thing. Any question? Anyone with a question? So we introduce limited liability companies. So just say in summary, we'll be doing a number of things here. We'll define a limited liability company. First, we look at the definition. Then we look at investment income, treatment of investment income. Then we look at installment tax. So there are only three areas. So investment income, we'll be looking at interest, dividend income, those are the three areas that we look at under limited liability companies. First, we define, then we look at how to treat investment income received by a company. So how do we deal with interest income and dividend income, and then the concept of installment tax. So let's start with the definition. How do you define a limited liability company? So please write this and say, the Income Tax Act, or short ITA, the Income Tax Act defines a company as, the Income Tax Act defines a company as, the Income Tax Act defines a company as open quotes, a company incorporated or registered. A company incorporated or registered under any law. A company incorporated or registered under any law in force in Kenya. A company incorporated or registered under any law in force in Kenya or elsewhere. A company incorporated or registered under any law in force in Kenya or elsewhere. Then you say, a limited liability company is considered as a legal entity. A limited liability company is considered as a legal entity, that is distinct and separate. A limited liability company is considered as a legal entity that is distinct and separate from the shareholders, or directors, from the date it is incorporated. From the date it is incorporated. From the date it is incorporated. Then you say, the profit of a company is chargeable to tax. The profit of a company is chargeable to tax. The profit of a company is chargeable to tax at the corporation tax rate. The profit of a company is chargeable to tax at the corporation tax rate of 30%. The profit of a company is chargeable to tax at the corporation tax rate of 30%. Very well. Then you go to investment income. Investment income. Then you say, the income from investments derived by a limited liability company, or simply LLC, the income from investments derived by a limited liability company, the income from investments derived by a limited liability company, LLC, may be in form of A, dividend income derived from investment in shares, dividend income derived from investment in shares of other companies, dividend income derived from investment in shares of other companies, dividend income derived from investment in shares of other companies, and B, interest income derived from fixed deposit accounts, interest income derived from fixed deposit accounts in banks, interest income derived from fixed deposit accounts in banks, and treasury bills and bonds, and treasury bills and bonds, and treasury bills and bonds. Then the next subheading, put interest income. Interest income. So you say interest income can be categorized. Interest income can be categorized as follows. 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 So A, you have this as non-qualifying interest. Non-qualifying interest income. Now we define interest income. So we say this is interest income that is taxable. This is interest income that is taxable at the rate of 15%. This is interest income that is taxable at the rate of 15%. Is taxable at the rate of 15%, which is not the final tax. Which is not the final tax. Which is not the final tax. i.e., the interest is taxable further. The interest is taxable further. The interest is taxable further at the corporation tax rate of 30%. The interest is taxable further at the corporation tax rate of 30%. However, withholding tax, or you can put in short WHT. However, withholding tax, or WHT, of 15%. However, WHT of 15% that was suffered at source. However, WHT of 15% that was suffered at the source is deducted or offset. Is deducted or offset. Is deducted or offset to determine the corporation tax payable. Is deducted or offset to determine the corporation tax payable. Is deducted or offset to determine the corporation tax payable. So that's the first type of interest. Another type of interest. Interest from infrastructure bonds. Interest from infrastructure bonds. So infrastructure bonds can be those that are issued by the government. How it will be treated will depend on the maturity, the number of years. So if the infrastructure bonds has a maturity period of 3 years, 3 years or above, then the interest will be exempted from tax. Like recently, the government issued a 20-year infrastructure bond. So you'll be earning interest, but the principal will be received after 20 years. You'll get back your principal after 20 years. You've lent the government. So big banks and institutions like NSSF like investing in this. So interest from infrastructure bonds, you say, any interest on an infrastructure bond, any interest received on an infrastructure bond, any interest received on an infrastructure bonds with a maturity period, of at least 3 years, with a maturity period of at least 3 years, is fully exempted from taxation. Is fully exempted from taxation. That's interest from infrastructure bonds. Then you see interest from foreign investments. Interest from foreign investments. So you say this is interest derived. This is interest derived from foreign investments outside the country. This is interest derived from foreign investments outside the country, which is fully exempted from taxation. 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 I'll put one last one, D, qualifying interest. Qualifying interest income. Qualifying interest income. So you say this is interest income that is received by an individual. This is interest income that is received by an individual. This is interest income that is received by an individual person. It is received by an individual person. By an individual person. Then you say withholding tax of 15%. Withholding tax of 15%. Withholding tax of 15% at the source. Withholding tax of 15% at the source is the final tax. Withholding tax of 15% at the source is the final tax, i.e., there is no further taxation. I.e., there is no further taxation. I.e., there is no further taxation. That's it. The next we look at dividend income. So as a way you look at dividend income. So look at dividend income. So you say dividend income derived by a limited liability company or simply LLC. Dividend income derived by a limited liability company. Dividend income derived by a limited liability company can be categorized as follows. Dividend income received by a limited liability company can be categorized as follows. A, qualifying dividend income. Qualifying dividend income. Then you say, this is dividend income. This is dividend income derived from investment in shares of other companies. This is dividend income derived from investment in shares of other companies. This is dividend income derived from investment in shares of other companies. It is taxable at a withholding tax rate of 5%. It is taxable at a withholding tax rate of 5%. It is taxable at a withholding tax rate of 5%, which is the final tax. It is taxable at a withholding tax rate of 5%, which is the final tax, i.e., there is no further taxation. I.e., there is no further taxation. I.e., there is no further taxation. Then B, non-qualifying dividend. Non-qualifying dividend. Then you say, this is dividend income received from farmers' cooperative societies. This is dividend income received from farmers' cooperative societies. This is dividend income received from farmers' cooperative societies. It is taxable at a withholding tax rate of 15%. It is taxable at a withholding tax rate of 15%. It is taxable at a withholding tax rate of 15%, which is not the final tax. It is taxable at a withholding tax rate of 15%, which is not the final tax, i.e., it will be taxed at the corporation tax rate. It will be taxed at the corporation tax rate of 30%. It will be taxed at the corporation tax rate of 30%. It will be taxed at the corporation tax rate of 30%. However, withholding tax of 15%, withholding tax of 15%, suffered at the source can be deducted or offset. To determine the corporation tax payer. Then we also look at installment tax. So what is installment tax? When you say this is a tax that is payable in installments. This is a tax that is payable in installments as the year is progressing. This is a tax that is payable in installments as the year is progressing. It is estimated at the beginning of the year. It is estimated at the beginning of the year. It is estimated at the beginning of the year. It is estimated at the beginning of the year as follows. So we use the previous year's tax liability. So it is estimated at the beginning of the year as follows then. So this is how you estimate. So you take the previous year's tax, previous year's tax liability, you multiply by the factor. So this factor is 110. Multiply by the factor of 110%. Previous year's tax liability multiplied by the factor of 110%. So that's how you estimate installment tax. Then you say, where a company has commenced its operations, in the current year, installment tax shall not be payable. Installment tax shall not be payable until in the subsequent year. Installment tax shall not be payable until in the subsequent year. Then you say the due dates for payment of installment tax are, so you have first installment. First installment is going to be 25%. The first installment is 25% of the tax, or estimated tax. It's payable by the 20th day of the fourth month during the year. Let's say it's 2023. And second installment will be 25% again of the same estimated tax. It's payable by the 20th of the sixth month during the year. So we are saying that because a company can operate any 12 months, it doesn't have to be the calendar year. Then third installment. Pay 25% of estimated tax. It's payable by 20th of the ninth month. Then fourth installment of 25% of estimated tax. It's payable by 20th of the 12th month. So that's it. So if you're operating between January and December, then the 12th month will be December. So that is what we call limited liability companies. I don't know if we can look at an illustration. Let's see if that's possible. So our first question, if you can turn to April 2024. April 2024, look at question April 2024, question 4C. It's called Lamek Limited. Lamek Limited. April 2024, question 4C. So April 2024, question 4 part C is called Lamek. Lamek Limited is a limited company or limited liability company. So if you can turn there, probably you can look at this. This is Lamek Limited. I'll read. Lamek Limited is a company engaged in manufacturing business. The following details were extracted from the financial statements of the company for the year ended 31st December 2023. Statement of profit or loss for the year ended 31st December 2023. Turnover, inclusive of VAT at the rate of 16%, profit on sale of motor vehicle, insurance compensation for stock destroyed by fire, less expenses, purchases, new furniture, salaries and wages, legal expenses, general expenses, corporation tax, advertisement, audit fees, office rent, purchased goodwill, repairs and maintenance, net profit. Additional information, purchases were overstated by 20% and includes carriage, cost of 20,000 for furniture. So carriage is transport for furniture for use in the business. Legal expenses comprise conveyance fees. They bought company land. Defending the company against tax evasion case, registration of trademark, negotiation of goodwill, renewal of a 100-year lease agreement, loan negotiation fees, defending company against a trade dispute, negotiating employee salaries with the trade union. General expenses include general allowance for bad debts, office partitions, purchase of photocopier, purchase of computers, donations to charitable organizations, construction of sewerage plants, repairs and maintenance included purchase of metallic doors, purchase of motor vehicle engine, purchase of plastic tank, construction of a fire exit. Advertisement costs include software expenses for office, computers at a cost of 190,000 required. Prepare a statement of adjusted taxable profit or loss for the year. Determine corporation tax payable or refundable, assuming total installment tax paid. Installment tax paid was 2,084,920. All right. So we'll first prepare a statement of adjusted profit or loss. So allow me to prepare a statement. This one. So the adjustment is similar or the same for all businesses. So we'll pick the profit provided, net profit. We'll say reported profit. So our reported profit is 2870.2. Then we say add back. So add back. So starting from the trading account. So in the trading account, we have note number 1. Yes. Note 1 says purchases were overstated by 20%. So that means the cost of goods sold was also overstated. If you overstate purchases, which means the profit was understated. You need to add back the overstated purchases. Also, there is carriage cost of 20, which is a capital cost. 20,000 was included in purchases. 20, which was for furniture. So two adjustments, both of them are add backs. So we say overstated purchases. So it was overstated by 20%. So if you start from 100%, you add another 20. So the current purchases is 120%. But we want whatever is above. Whatever is above is 20 out of 120. So the overstatement is 20 divided by 120. You multiply by this purchases figure. The purchases figure is given as 2880. So that should give us the overstatement, the 20% out of 120. So 20 divided by 120 times 2880. It gives us 480. So you add that one. Then you also add back carriage was included in purchases. So carriage for relating to furniture. So it's a capital expenditure, but it was included in purchases. From note 1, it was 20, another 20. So we fully adjusted for note 1. So those expenses overstated cost of goods sold and understated profit. So we added them back to profit. Do we have any other adjustment in the trading account? Yes, probably the VAT included in turnover, but that one will deduct. It has been included in turnover and it's not part of turnover, so that one will be deducted. Then less expenses. The first expense is purchases. We've already adjusted that. New furniture is capital expenditure, so add back new furniture. New furniture is that. Salaries and wages, we check additional information is allowed. Salaries and wages. Legal expenses, we have note 2. There was conveyance fees for buying land, 40. So conveyance. So this relates to land. Defending the company against tax evasion. So tax evasion is an offense. To defense of tax evasion. We add back that cost defense of tax evasion, 68. Registration of a trademark is also a capital cost, registration. So registration of trademark is 42. That's a trademark is an asset. Negotiation of a goodwill, even goodwill is an intangible asset. So negotiating goodwill is added back. 40. Negotiation. Renewal of a 100-year lease agreement, so that's more than 99, so that's not allowable. So renewal of a 100-year lease. That's 36. Loan negotiation fees is a preliminary cost. So what is allowable is interest after the loan has already been received. The negotiation fees is preliminary. So loan negotiation fees. Loan negotiation fees. Defending the company against a trade dispute, that's business. So they can have a trade, probably a customer is disagreeing about the invoice value, trade dispute, that's normal. Negotiating employee salaries with the union, no. Negotiating salaries. So for employees, should be the cost of preparing their contracts, employment contracts, not negotiation with the union. Of salaries with the union. So that's legal expenses. Then you have general expenses. We go to note 3. There's a general allowance for bad debts. So bad debts which are general. So bad debts. We have general provision or general allowance. General allowance for bad debts is 38.4. Office partitions is 60. Because partitions is capital expenditure, that's capital cost. Office partitions, purchase of photocopier is 180. Purchase of computers is 350. Donations to charitable organizations is allowable. Construction of sewerage plant is a capital expenditure. So construction. Sewage. That is capital expenditure. Sewerage plant is 680. Corporation tax in the statement is given as 464. So corporation tax. Advertisement. Do we have a note on advertisement? We don't. Yeah, we have note 5. Advertisement costs include software expenses for office computers at a cost of 190. Huh? So software cost is 190. It's included in advertisement. Audit fees is allowable. Office rent is allowable. Purchase goodwill is intangible. So purchase goodwill. So that's an intangible asset. Purchase goodwill 90. Repairs and maintenance, we have note 4. Purchase of metallic doors. So we have metallic doors is capital expenditure. Metallic doors is 28.2. Motor vehicle engine. Motor vehicle engine is 54. Purchase of plastic tank is also capital expenditure is 60. Construction of fire exit is okay. Construction of fire exit will be okay. So construction of fire exit is allowable. Why? Because it's a requirement of the law. So fire exit will be a requirement of the bylaws of the county. So we're done with repairs. So these are the adverts. Then deduct. So for deductions, we look at the income side. Turnover, we are going to deduct the VAT. VAT included in turnover. In turnover, so it's going to be 16 over 116. We multiply by this turnover, 97.44. 16 over 116 times 97.44, we get the VAT included. So 16 we divide by 116, then we multiply by 97.44. So 1344 is VAT, we deduct. We are still on the income side. Profit on sale of motor vehicle 260. So profit on sale of motor vehicle is capital. Motor vehicle 260. Insurance compensation for stock destroyed by fire, that's okay. Then in this question, the examiner has not provided investment allowances, so we'll calculate all of them. Investment allowances, we'll come here and say investment. By the way, that's our next topic. Our next topic after limited companies will be investment allowances. But by that time, I'll introduce public finance in one of the topics as I continue with the investment allowances in the other. So investment allowances, let's see. If you look at the statement, there's new furniture. So we get allowances for furniture. New furniture, the rate is 10%. 10% times the cost of new furniture, 400. So deduct 40. That's new furniture. Legal expenses, general expenses. Under general expenses, look at note 3. We have office partitions. Office partitions. The rate is 10%. These rates are usually given in the exam. They're given in the first page. So office partitions is 60. 10% of 60 is 6. So we claim 6. Then there's a photocopier. So there is photocopier. Photocopier is 25%. It's in the same category as computers. Photocopier 25% of 80 is 45. That's photocopier. Then we have computers 350. So computers will be 25% of 350. And 5% of 350 is 87.5. That's computers 87.5. Then there is sewerage plant. Now that would be 50%. In the first year, you give 50% on sewerage plant. So 50% of 680 is 340. Okay, that was under general expenses. Then we have under repairs and maintenance, we have metallic doors. Again, 10% of the cost of metallic doors. Metallic doors, the 28.2. So that will be 2.82 for metallic doors. Purchase of motor vehicle engine. You cannot claim an allowance for the engine unless it was a car. The asset must be in use. It must be in use. So an engine separate from the car is not in use. So you claim an allowance for the car, not for the engine. So we will claim for plastic tank of 60. So finally we have plastic tank. 10% of 60 is 6. Then we can get our adjusted taxable profit for company. Let me start with the deductions. 1344, you add 260, you add 40, you add 6, you add 45, you add 87.5, you add 340, you add 2.82, you add 6. So the deductions, you can confirm this. The total will be 2131.32. Those are deductions, 2131.32. Then add backs the 480 plus 20 plus 440 plus 68 plus 82 plus 36 plus 174 plus 98.4 plus 180 plus 350 plus 680 plus 464 plus 190 plus 90 plus 28.2 plus 54 plus 60. So total additions, again, you can confirm this is 3494.6. Then that I add to the reported profit plus 2870.2 minus this, minus deductions 2131.32. The result is a profit we'll call this the adjusted taxable profit of the company. This is adjusted taxable profit. So it will appear in the second column below. The adjusted taxable profit in the second column, let me not put a double line first, is 4,233.48. Then you look for any other taxable income to add to that. Like for Lamek, there wasn't any other income you can add. Other sources, kama kuna rent on commercial building, kama kuna interest from banks, it's taxed twice. They didn't have that, and this becomes the taxable profit. 4233.48. Any question? Then very quickly, I'll calculate tax, corporation tax. So corporation tax, liability is 30%. So 30% times 42, 23, 18. So you get 5% of that is corporation tax. That gives you 1,270,044. But then they have paid some installment tax during the year already. That is the note number 2, Roman 2, in the question. Determine corporation tax payable or refundable. So this would be corporation tax refundable, assuming the total installment tax paid. So installment tax have been estimated during the year and they have overpaid. They paid 2,084,000. So we say less installment tax. Installment tax. The installment tax paid was 2 million. 2084,920. There's tax refundable. Say tax refundable. They have overpaid. What had been estimated during the year is much greater. So 2084,920. So this is, I don't think this is true. This is 814, 876 negative. So that's a refund. So that's it. Probably niwapatie assignment moja. You try for the next class. The assignment will be December 2023, question 4B. So you can try as an assignment, December 2023, question 4 at B. And that question is called Bright Decker Limited. Bright Decker Limited. So you can try that for the next class. So please have a good weekend. So we'll see you next week. Like I said, next week I will be introducing investment allowances, the topic after this, and I'll also introducing public finance. I think for the Sunday class, I'll introduce public finance. Then Friday, I'll be continuing with investment allowances until it's complete. Then we can use the 2 classes for taxation after we are done with public finance. So next week, I'll introduce public finance. So asanteni sana, have a good weekend.